Welcome to the MUFG Global Markets podcast. I'm Jonathan Wong, an analyst on the MUFG Macro Strategy team, and today I'm joined by our team lead, George Goncalves, Head of U.S. Macro Strategy. It's Tuesday, August 20th, 2024. Welcome back to the podcast, George.
Thanks, Jonathan, for hosting.
George, we have seen a pretty volatile start to August, but after a few major moves around the end of July into early August post the doubleheader BOJ and FOMC meetings, followed by weak NFP report, which helped serve as a catalyst for what has been now known as the start of the yen carry trade unwinds. We have seen risk markets bounce back, but yet the rates markets have not fully retraced, with yields still meaningfully lower now versus earlier in the summer. What is going on with the price action across various markets that we are seeing such divergences again, but yet falls have come in?
Yeah, that's a great point, and it's well deep into August, and most of this early volatility at the beginning of the month. Some call it a panic in reaction to what is known as the potential for the yen carry trade being adjusted, and as we've kind of highlighted in other reports, this idea that this unwind seems too precise and clean of an assessment that an actual unwind took place, more like positioning realignment and perhaps pretty quick and sharp moves, which exacerbated the volatility that we saw in various asset classes as positions were adjusted. But the idea of a full unwind, I think it's a little bit too premature to get to that conclusion. But I do think that it did remind us and continues to remind us of how the market structure and how both in terms of available liquidity as well as tendency for broader risk markets to kind of have this mentality of buying the dip, that once the dust settled post these big gyrations in the macro products like FX and rates, the risk assets went back to their kind of standard uptrend that we've seen all along throughout the year. But it has created, as you pointed out, it has created these divergences between what the macro products are telling us versus the stock market and other risk assets. And I think the jury's still out. It's August. We were warning, as you know, that August typically starts the period that's unfavorable from a seasonal perspective, that we're entering the period that typically could be more volatile. So in that sense, you can kind of check off the box that we did get more volatility. But the fact that it's kind of calmed down doesn't mean that we're going to stay in this calm period for much longer, and maybe throughout the rest of the month. But then once we get back in September, we do think there's a number of things that could result in vol coming back. And so I think it's just a reminder of the market structure, the tendency for the sort of buy the dip and these liquidity air pockets that happen so often. But this one, much larger than what we've experienced in recent history. I think it was just a reminder of how fast markets can move. And therefore, as we've been saying and been writing about, we're still cautious on the outlook.
How about we shift our focus ahead? You're recording this on Tuesday, August 20th, which is a data light week, but we get to hear from Fed speakers and other central banks at the annual Jackson Hole Symposium. With Chair Powell's keynote speech on Friday at 10 a.m., what should we be looking out for, and what else is there before we look to close out August and eventually that back to school feeling returns to markets in early September?
Sure, exactly. And so this week we do get, which something that now everyone's focused on, which we've been focusing on for a much longer time period, this idea of the job revisions. So on August 21st, the day where this recording will get released, we'll have seen the QCEW job revisions, and we'll see if that results in a big enough decline that it changes the perception of how robust and how resilient has the labor market been. And that could be an input ahead of the various Fed speakers start to kind of assess what that means for the outlook. And it could be a determining factor for how Chair Powell kind of does any sort of last minute touches on his speech on Friday. So that's going to be important. We also have the at 2 p.m. also tomorrow, Wednesday, the 21st, the Fed minutes, which that FOMC meeting in July we characterized as a kind of a dovish conclusion, and that probably should come across in the minutes as well. And there was potential for various Fed members thinking about cutting in July, as Chair Powell mentioned during the press conference. So we're going to be clued into the minutes, the QCEW data that comes out earlier in the day on Wednesday, the 21st, and then the 23rd on Friday at 10 a.m. Chair Powell will have one of the kind of keynotes opening speeches for the Jackson Hole Symposium. And it's an opportunity for him to assess what's transpired in the post meeting, where we've had a weaker NFP, inflation continuing to decline, but yet we had this kind of odd, stronger retail sales. I think that Chair Powell will use this opportunity to emphasize the balance of risk has clearly shifted towards concerns about the labor market more so than inflation. That inflation continues to go in the right trajectory and is on track to get towards their target. So that now's the time to really shift focus towards the labor market, which is clearly decelerating and has been, and could be even weaker than what we expect because of these revisions that we'll see on Wednesday. So I think it's going to be kind of a capping stone towards all this sort of data that we've been looking at here at MUFG Strategy, as you know. And for those that follow our work, we've been one of the few houses that have really emphasized this pivoting towards the labor concern being more critical for the trajectory for rates, and that's going to open the door for rate cuts. And we do think that they're in store for September. And the question really comes down to, is it 25 or 50? I think we're going to learn a little bit about that. And then further along, once we get past August, we'll be focusing on the data that will be released in September. After Labor Day, we have the jobs report on the 6th. And if that is weaker than expected, that could open the door for a 50 basis point cut. So still think that the data is going to be important. We then have also one more inflation reading before the Fed. And then we get into the election cycle with the debates that are going to take place in September and October. So I think it's going to be getting the data to get the Fed to cut rates either 25 or 50. Baseline is at least they're going to do 25, and to do 50, we got to see the revisions come in weaker, as well as a weaker MFP. And CPI, we think, will continue to trend lower over the coming next 2 months before it stabilizes into the fall. And so, yeah, that's the key focus. And then we'll see how the election cycle shakes out.
Thanks for that, George.
Thank you, Jonathan.
We would like to remind our listeners, for those that would like to receive George's strategy reports directly, please email your MUFG sales coverage or get into contact with George directly on email or Bloomberg. Thank you for listening to the MUFG Global Markets podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts, and reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets research team.